Billions of dollars simply evaporated. This is the undeniable financial force of an Elon Musk tweet. A single post just days ago, on a Monday afternoon, caused a staggering 10% plunge in the value of one major technology stock, shedding nearly $50 billion from its market capitalization in mere minutes. Investors watched in disbelief as their portfolios turned red, then plummeted further within a 30-minute window. It was not a grand announcement nor a detailed financial report, but merely a few cryptic words online that sent shockwaves through global markets. His previous infamous tweet, involving a popular cryptocurrency known as Dogecoin, once saw its value surge by over 800% in just 24 hours, then later dip significantly, leaving thousands of small retail investors in a state of wild speculation and considerable loss. The Securities and Exchange Commission previously levied a $40 million fine against him and his company for market manipulation, yet the influence of his words remains incredibly potent and largely unchecked. This digital fingerprint, a simple string of 140 characters or even fewer, carries immense power, affecting countless lives and retirement funds globally. Imagine millions of trades executing instantly because one person with over 100 million followers decides to share a spontaneous thought or a controversial meme. That rapid reaction then creates a cascading effect where algorithmic trading systems pick up on the initial volatility, amplifying the market swings even further. We saw this unfold when talk of taking a company private at $42 a share led to an immediate stock price jump, then a subsequent nosedive when the deal faced regulatory hurdles. It is a new era of market dynamics, where individual influence, particularly from high-profile figures like Musk, can dictate fortunes and reshape entire sectors overnight. This phenomenon highlights a stark reality about modern finance, where traditional fundamentals can be momentarily overshadowed by the sheer viral spread of information or misinformation. The global financial system now operates with an unprecedented level of interconnectedness and speed, making it highly susceptible to these seemingly small but tremendously impactful digital events. There is no historical parallel to such instant and widespread market disruption stemming from a personal social media account. Financial institutions, analysts, and everyday traders now have to contend with this unpredictable variable, a single person's online activity. It represents a profound shift in market control and accountability, a power that one individual holds over the collective wealth of millions. The ripple effect extends far beyond the immediate stock price, affecting supplier contracts, employee morale, and even national economic indicators when the market capitalization of giants shifts so dramatically. The sheer volume of money at stake is astronomical, often exceeding the entire annual budget of small nations, all hinging on a few taps of a keyboard. This 21st century market reality continues to challenge regulatory bodies and established financial protocols as they scramble to understand and perhaps control such an unpredictable force. Global fortunes evaporate in milliseconds, instantly changing lives. Elon Musk's digital pronouncements regularly trigger seismic financial shifts, impacting literally millions of investors. This phenomenon demands a new level of regulatory scrutiny, a task proving incredibly difficult for bodies like the Securities and Exchange Commission. Traditional market watchdogs were designed for a slower, more predictable environment, where quarterly reports and analyst calls shaped investor behavior, not spontaneous digital declarations. The current situation sees nearly 60% of all daily trades executed by high-frequency algorithms that scan millions of data points every second. These automated systems are programmed to react to sentiment changes or specific keywords, amplifying initial market swings by factors of 3 or 4 within nanoseconds. We observe sudden upward or downward pressures, affecting stock valuations by 7% or even 8% purely on the back of a single tweet. This instant reaction is not limited to one country. A tweet posted from California can trigger sell-offs in Tokyo within 5 minutes, and then cascade to London and New York in under 15 minutes, impacting literally thousands of different securities across 3 continents. Small retail investors, making up almost 70% of certain online trading platforms, often follow these digital trends without fully understanding the underlying economic shifts, potentially losing thousands of dollars each during sharp market corrections. Large institutional funds managing assets exceeding $8 trillion now allocate dedicated teams to monitor social media streams specifically for influential figures like Musk to preempt sudden price movements. The sheer volume of wealth influenced daily by these digital interactions can reach hundreds of billions of dollars, effectively making social media feeds a new form of financial newswire, but without the traditional journalistic vetting process. This raises critical questions about market fairness and the equitable access to information when a few chosen individuals hold such disproportionate sway. Regulators worldwide, from Germany's BaFin to the United Kingdom's Financial Conduct Authority, are grappling with policies that could impose fines upwards of $100 million for clear market manipulation. Yet the line between free speech and market influence remains blurred. The financial technology sector is responding by developing new artificial intelligence tools designed to predict these social media-driven market movements, hoping to gain a 20-second advantage in a world where every millisecond counts for profits or losses. These tools analyze billions of online conversations, tracking investor sentiment across hundreds of different platforms. This 21st century market reality marks a stark departure from the past, where market corrections typically took days or weeks to unfold. Now they happen in 30-minute bursts, requiring an instantaneous response from traders and governments alike. The interconnectedness of global markets means a single event can cause a domino effect, affecting hundreds of companies and millions of individuals simultaneously, impacting an estimated 700 million users globally. Billions vanish with a single tap. Elon Musk's brief messages now regularly spark financial earthquakes, fundamentally reshaping how we understand market stability and individual influence. This extraordinary power highlights a new era where a single person's digital fingerprint carries far more weight than many governmental policies or traditional corporate announcements. Imagine a world where 7% or even 8% of a stock's value can disappear in a matter of minutes, all because of one person's choice of words. It is not just about the immediate financial fallout affecting thousands of securities across 3 continents, from Tokyo to London to New York, in less than 15 minutes. It is about the lasting digital trail that one single tweet creates a permanent record of intent and impact. Regulators like the Securities and Exchange Commission, designed for a slower-paced environment, now struggle to keep pace with these instantaneous digital declarations. Their traditional tools are inadequate for policing a landscape where high-frequency algorithms execute 60% of daily trades, reacting within nanoseconds to sentiment shifts or specific keywords. These automated systems amplify initial market swings by factors of 3 or 4, turning a ripple into a tsunami for millions of investors. Small retail investors, who make up almost 70% of some online trading platforms, are particularly vulnerable, often losing thousands of dollars each when market corrections hit. The collective wealth influenced daily can easily reach hundreds of billions of dollars each day, demonstrating the unprecedented leverage held by influential figures. This situation demands an entirely new framework for accountability, one that acknowledges the immense power of a digital utterance. The challenge for authorities worldwide, from Germany's BaFin to the United Kingdom's Financial Conduct Authority, involves defining the blurry line between free speech and outright market manipulation. Fines upwards of $100 million for clear violations are being considered, but enforcement is incredibly complex. The digital fingerprint is indelible, yet its full implications are still unfolding. Financial technology companies are investing heavily in new artificial intelligence tools to track billions of online conversations, hoping to gain a 20-second advantage in these lightning-fast markets. This technological arms race illustrates the new reality, where every millisecond counts for profit or loss. Market corrections, once taking days or weeks, now occur in 30-minute bursts, requiring an immediate human and automated response. The global interconnectedness means one digital action can affect hundreds of companies and literally 700 million users across the world simultaneously. This digital power truly changes everything about how we perceive financial control and personal responsibility. The sheer volume of data points created by every single online interaction forms an extremely complex web of influence that is difficult to untangle and nearly impossible to predict.